In today's video, we're looking at an important question. Why is the price of gold rising? We'll break down the key drivers, look at data and trends, and analyze what this all means for investors, economies, and your own portfolio. So let's dive in. As of 2025, the price of gold has surged to record highs. According to the World Gold Council, gold rose 26% in US dollar terms in the first half of 2025 alone. It hit over 4,000 US dollars per ounce in October 2025. It's safe to say something is driving gold's price strongly upwards. The question is, exactly? One of the most consistent drivers of gold's price is its status as a safe haven asset. When economies wobble or geopolitical risk rises, investors look for assets less tied to corporate earnings, interest rates, or credit risk. Gold has historically filled that role. Let's unpack how this works right now. Geopolitical tensions, e.g. trade frictions, war, or sanctions, create uncertainty. The more uncertain the world looks, the more attractive gold becomes. As one analysis found, nearly half, 47%, of the recent run-up in gold could be attributed to global economic uncertainty. Investors worry about growth, inflation, central bank policy, currency stability. When confidence in the status quo drops, the premium for gold goes up. For example, the price of gold is higher when the real interest rate is lower, when inflation is higher, and when uncertainty is higher. In effect, gold acts as a hedge, not perfect, but a way for investors to say, I'll hold something that isn't someone else's liability. So driver number one, the rising uncertainty, global, economic, political, is boosting demand for gold. Another key dimension, gold doesn't pay interest, it's a non-yielding asset. So its attractiveness depends a lot on what else investors can get and what opportunity cost they face. Two interlinked factors matter: real interest rates and the strength of the US dollar. Real interest rates. These are nominal interest rates minus inflation. When real rates are high, fixed income assets become more attractive. You earn more after inflation. That tends to suppress gold. But when real rates are low or negative, the opportunity cost of holding gold falls. Many studies find gold prices climb when real rates fall. The US dollar, because gold is typically priced in USD globally. When the USD weakens, gold becomes cheaper for holders of other currencies, thus more demand, and vice versa. Likewise, a strong dollar tends to suppress gold. What's happening now? The drop in the USD or downward pressure is a tailwind for gold. Expectations of looser monetary policy, e.g., interest rate cuts by the Federal Reserve, make gold more attractive. Thus, driver number two, low/negative real rates plus a weakening dollar equals strong support for gold. Gold's price isn't just about individual investors. It's also about large systemic actors, especially central banks and sovereign wealth funds. In recent years, many central banks have been buyers of gold reserves, rather than sellers, as had been the case earlier. That shift is structurally meaningful. Why does this matter? Central bank demand is large in volume relative to incremental mine supply. When central banks buy, it reduces the free supply available and also sends signaling effect. We trust gold more as reserves. Structural shifts. Some central banks are diversifying away from the dollar-centric reserve system. For example, central bankers expect the share of the US dollar in reserves to decline and believe gold's safe haven role during geopolitics will remain relevant. Hence driver number three, robust central bank buying plus structural reserve diversification is underpinning higher gold prices. While much of the focus is on investment demand, there are also supply/demand fundamentals at play. A quick look. Supply. Mining output of gold is relatively small compared with total above-ground stock. New annual mine production adds maybe 2 to 3% to the existing stock. Thus, large demand shifts get magnified into large price shifts. Consumption demand. Jewelry and industrial use, electronics, medical devices also matter. though for gold these are smaller than investment flows. In current context, while jewelry demand is important in India, China, the main push is from investment/central bank demand rather than a sudden jump in electronics usage. E.g., at Tufts University, Peace observes, the leap cannot be explained by a sudden increase in the demand for gold as jewelry or for its use in industrial production. Rather, it reflects the shifting demand for the yellow metal as a financial asset. So driver number 4, limited incremental supply plus structural constraints amplify upward pressure when demand rises. We have multiple drivers. Let's integrate them to explain why this surge is happening right now, 2024 to 25. Consider the following interplay. Economies are showing signs of softness. Inflation remains elevated. Geopolitical tensions remain elevated. Trade, war sanctions. That raises uncertainty, safe haven, demand goes up. Real interest rates have come down, or expectations of them dropping, and the dollar is under pressure. That reduces the opportunity cost of gold. Central banks are stepping in higher volumes to buy gold reserves, a structural shift. The incremental supply of gold is limited, so with higher demand, price moves are amplified. Meanwhile, many investors are now picking up gold via ETFs and other structures, which adds a layer of financial flows beyond just bullion demand. Thus, we're seeing a convergence of factors, not just one, that is pushing gold higher. Because when you get many bullish drivers simultaneously, the effect can be more than additive. It can be exponential. For example, according to the WGC, gold reached $4,000 per oz on October 8th, 2025 after moving from $3,500 in just 36 days. Analysts at E.G. Goldman Sachs expect further upside, driven by these structural drivers. It's important to recognize that while the case for higher gold prices is strong, there are risks and caveats. Opportunity cost. If real interest rates rise, e.g. inflation falls and central banks hike, gold becomes less attractive since it offers no yield. Dollar strength. If the USD strengthens, that can weigh on gold. Market sentiment. Much of gold's value comes from psychology of hedge/trust. If confidence returns to other assets, stocks, bonds, gold might underperform. Past performance caution. One study points out that in the decade after a big gold run-up, returns have sometimes been very low or even negative. Speculative excess. When many drivers align, sometimes markets overshoot. So one must watch for potential corrections. Thus, while the bullish case is strong, investors should remain mindful of timing, valuations, and portfolio context. What does this mean in practical terms? For investors, gold may be considered as a hedge or diversification tool, especially in an uncertain environment. But one must weigh size of allocation, valuation, and how it fits into the overall portfolio. For economies/central banks, a rising gold price signals shifts in reserve management, currency/monetary trust, and potentially changing roles of fiat currencies. Large gold purchases by central banks suggest long-term strategic thinking around reserve diversification. For markets, a strong gold rally may indicate broader worries, e.g. inflation, debt, currency risk, that could impact equities, bonds, and global growth. If gold is rallying for bad reasons, i.e. fear rather than optimism, that could portend broader stress. For consumers, in regions where gold is a cultural savings asset, e.g. India, Middle East, higher gold prices can affect affordability of jewelry, but may also encourage more investment in bullion. If you're tracking gold, here are some key variables to keep an eye on. Real interest rates. Watch for shifts in inflation, central bank policy. Real yields, particularly in major economies. U.S. dollar index. A weaker dollar tends to support gold. Strength tends to suppress it. Central bank flows. Reports of large gold purchases or reserve changes can be signals. Geopolitical risk and economic uncertainty. Major shocks or systemic risks are gold tailwind. Conversely, normalization can reduce its appeal. Gold supply versus demand trends. While supply is more stable, any disruptions, mining regulation, or major changes in jewelry/industrial demand can matter. Valuation and market positioning. Some markets may already price in many of the bullish drivers, so monitor sentiment, ETF flows, speculative positioning. In summary, the price of gold is rising for a multitude of reasons, which is what makes this rally particularly strong. These include high economic and geopolitical uncertainty, safe haven demand low, or negative real interest rates plus weak dollar. Gold becomes more attractive structural central bank demand and reserve diversification, large permanent buyers, limited incremental supply, and amplified demand, big price moves, while timing and valuation risk remain. For many investors, the role of gold as a hedge, portfolio diversifier, and strategic asset is looking more compelling in 2025. If you're thinking about what this means for your portfolio, it's worth asking. What is my objective in holding gold? What's the allocation that makes sense? How much risk am I comfortable with if this rally reverses? Thanks for watching. If you found this video useful, please hit the like button and subscribe for more deep dives into markets and macro trends. And if you have questions or wanting to dig into gold mining stocks, gold versus crypto, or anything related, drop a comment below and I'll cover it in the next video. See you next time.